Hi, and welcome to the Q1 market update. My name is Doug Johnson. I am the senior investment strategist here at HCM, and we just wanted to take some time today to go over our thoughts and positioning for Q1 of 2020. As a quick reminder, we will have a longer, more detailed version of this presentation available on the website as well. But for now, this is more of what we would call the executive summary, so to speak. So let's go ahead and get started. On the stock side, we have kept our model targets at neutral with a slight reduction in what we would call defensive positioning. So we had added a small sleeve of minimum volatility into our models. And as we've seen things improve, not only price-wise, but also seeing the Fed and a tentative China deal reached, we feel like we can begin to remove some of those defensive positionings, and we've done so here at the beginning of the year. So a commitment by the Fed to lower rates, we believe, will continue to support equity markets. As a quick reminder, going back to the end of 2018, beginning of 2019, you still had the Fed planning on possibly raising rates an additional 3 to 4 times in 2019. As the market sold off pretty significantly, the Fed backpedaled on that, basically said we're not going to raise rates, and then transitioned to actually coming out and saying we may cut rates, which they did do, and that has been a main driver of this equity rally that we've seen since that low at the end of 2018. We've also seen cyclical sectors replace defensive as the strongest performers towards the end of the year. So we believe that this is a sign that overall confidence is increasing, and that generally has been good for equity prices. Finally, a phase one tariff deal, along with a weakening dollar, has set the stage for the potential of outperformance for international assets. We've increased our international positioning just slightly. We know that over the past 10 years, it's been a tough road for international assets versus U.S., but we do think that the opportunity is starting to present itself for the possibility that international could begin to outperform the U.S. again. But we're slowly easing into increasing our international assets, and again, we're still below neutral with our international holdings and slightly overweight U.S. On the fixed income side, our portfolio duration remains slightly below benchmark levels. Just as a quick reminder, duration is a fancy term used to describe the difference between, the relationship between interest rates and price movements for bonds. So if you had a portfolio with a duration of 5 and interest rates moving up 1%, the price of that bond would go down 5%. So portfolio duration was a significant driver of fixed income performance in 2019 as rates dropped significantly, and now we've kind of seen things settle down a little bit, but we still remain slightly below benchmark levels. Confidence in the return of stronger economic growth, we believe, could drive rates higher, and in a weird way that would provide a headwind not only for fixed income versus what we saw last year, but possibly for equity as well. And when we talk about having a slightly lower duration, part of the reason is that if rates were to move up, lower duration would soften some of that price depreciation in fixed income. Looking outside just the regular benchmark levels, spread sector assets like high yield, emerging markets, and credit overall could outperform if rates do move higher, but we believe those assets are still very expensive versus historical norms, and there's not a whole lot of opportunity there in terms of risk versus reward. Our base case for the rest of the year is for rates to stay range bound. If we put a number to that, my guess would be that having the 10-year Treasury trade but somewhere between 1.5 and 2%. On an economic front, we've seen global growth forecasts. They have improved slightly, mainly aided by this phase one tariff deal that we've seen. Um, the main hope for that is that the phase two negotiations will continue on, and eventually we could get to a comprehensive deal, which would certainly remove a lot of the headwinds that we've seen for growth forecasts over the past several months. Not only that, we have seen some possibility of troughing in some of troughing or bottoming in European economies, which again would provide an opportunity for the possibility of international asset outperformance. U.S. recession concerns remain, though they've certainly subsided as the Fed has recommitted to maintaining lower rates. Inflation, again, remains right at or slightly below the Fed's target of 2%. I feel like we've had this bullet on the slide for almost 2 years now, but inflation just has not budged any higher right now. Finally, political issues will begin to come into focus as the election rhetoric begins to heat up. I think once it becomes clearer who the Democratic candidate will be, and we can start seeing some head-to-head polling, assuming that Trump wins the Republican nomination, and see how that might affect markets going forward. But for the time being, that's still getting sorted out. So finally, what risks do we see going forward? Slowing economic growth, accelerating into a recession. Again, right now we don't see recession on the horizon, but the possibility that we could slip back into a recession certainly remains top of mind for a lot of investors. Any rollback of the phase one tariff deal. So the deal's been signed, so the likelihood of that is low. But again, the uncertainty that's been involved in the entire tariff process certainly doesn't rule out that some kind of regressive action could take place. And my guess is the market would not take kindly to that. Any unexpected message from the Fed on the direction of future policy? The expectation for this year is for the Fed to just kind of be quiet, not necessarily cutting, not necessarily raising, but just to keep status quo. So I think if we saw an additional cut that wasn't on the basis of severely slowing growth, maybe seen as a positive, but I don't necessarily think there's a scenario right now, whereas if there was a rate hike, it would be seen as a positive. Geopolitical tensions with Iran, if that were to accelerate into a full-blown conflict, for the time being, it seems like we've kind of avoided the worst-case scenario, and the situation has kind of come and gone, I think a little more quickly than most people would have expected, but nonetheless, certainly something to keep an eye on. And then finally, we mentioned inflation earlier, but if we did see an unexpected increase in inflation to the upside, I think that might cause some problems, not only on the bond side, but possibly on the equity side, because as I mentioned earlier, it may put the Fed back on the table to go ahead and have to raise rates to combat that inflation. So again, as a reminder, we do have a longer version of this presentation that goes into a little bit more detail on these topics. So if you're interested in that, feel free to go to the website and click on that link when it's available. But I want to thank everybody for joining us today. As always, if you have additional questions, comments, or concerns, please reach out to your advisor, and we'll be more than happy to assist you with that.